Hi guys, Adam Khoo here, and the big news of the day is Facebook. Facebook, as you know, unless you've been living in a cave, had a huge crash after its latest quarter 2 earnings report. It had the biggest single day loss in its history and the biggest market value drop in the history of the stock market for the last 140 years. Okay, so it's big news. And I've been getting a lot of questions from students, from friends, asking me, hey, is this the time to buy Facebook? Is this a great buying opportunity or should I stay away? So I'm going to show you as a professional investor and trader how I break it down, how I analyze an investment to know, is it a good investment and is it time to go in or should I wait? So if you're ready, let's begin with this whole analysis. So first of all, what happened, right? So Facebook had its stock drop 20% in one day after announcing its second quarter earnings report last week. It was the biggest single day loss in the history of the entire stock market. It's a $120 billion loss in one day. So there are many news articles on it. You can see one on CNBC. And well, this is a stock chart, price went up. There's a huge gap down. So those people who were long, and even if they had a stop loss, it would have been taken out. Right, gap down way below the stop loss, we have lost a lot more than you have bargained for. And that is why as a trader, you never ever hold a trade during earnings. You always exit before earnings, no matter what. Because when this kind of shit happens, you can lose a lot more than your intended risk. Okay, but of course as an investor, you may not have a stop loss. You just hold it through, and if it's a good company, you hold it through and buy more at a lower price to average down your costs, or you just close your eyes and ride it through. So it really depends on whether you are a trader or an investor. So again, as a trader, you must always exit your position before earnings are announced because you're a short-term trade in the market, right? But as an investor, if you've got a many-year horizon, like Warren Buffett, then who cares, right? Just hold it. If you believe in a company, if it drops, you buy some more. So I'm going to analyze Facebook from the perspective of both a trader as well as an investor. And are there opportunities for both? So first the question would be, what caused the panic selling? I mean, this was really panic selling. 20% drop in Facebook is huge news, okay? So basically what happened was when Facebook announced their quarterly report, second quarter report of 2018, they had a revenue miss of 1%. That's all? Yeah, just 1%. They missed revenue by 1%. What's the freaking big deal, right? So basically what happened was they were expected to earn $13.16 billion. Instead, they made $13.04 billion. So it was just a slight miss of revenue. Okay, so that was the first thing that happened. Second thing, it was the first time there was a fall in daily active users, the number of people using Facebook daily in Europe. So in Europe, there was a 1% fall in active users. But in North America, there was no fall, there was no increase. It was a flat result in the US. Okay. So at first glance, you may say, hey, it's an overreaction because they just missed revenue by 1%, right? What's the big deal? Users drop by 1%, but the stock drops by 20%. That's an overreaction, right? At first glance. But what made the market panic was not the results per se. It was what the CFO said was going to happen in the future that freaked people out, okay? Remember, Facebook is a stock that has always beaten expectations. Whenever people thought it would hit a revenue, you do a lot better. So the moment a company disappoints its investors for the first time, people freak out. That's number one. Number two, the CFO said that, you know what? We expect further decline in revenue growth. Now listen to that carefully. He did not say decline in revenue. So he said decline in revenue growth, which means revenue is going to still keep growing. Revenue is not going to decline. It's not going to grow as much as it did previously. So what did the CFO actually say? He said that he expects further decline in revenue growth rates by the high single digits in the next 2 quarters and for the rest of the year. And that freaked people out. They say, oh my God, we had a drop in revenue. We're going to drop even more in the next 2 quarters by high single digits. Oh my God, Facebook, it's over. The growth is over. It's going to be like Nokia, or it's going to be like Sony in the past. From a growth stock, it's going to become a mature company, right? No more growth, and people panic and sell, the whole thing collapses. And I'm here to break it down to you guys to see, okay, is that a rational conclusion? Is Facebook's growth over? Is it now a mundane, a mature company? Or is there a lot more growth left? Is it an overreaction? So let's break it down for you guys, okay? Now, whenever I analyze an investment, there are a few questions that I always ask myself. Number one, is this in the first place a good business to invest in? Are the fundamentals solid in this company? So in order to know if it's a good business, few things I look at. Number one, does this company generate consistently increasing revenue, net income, and cash flow from operations consistently over the years? And will it continue to do so in the future? That's number one. In other words, can it make money? Right? Because if the company can increase its sales, its income, and cash flow consistently, its value will increase over time. When its value increases, becomes more valuable, the share price will eventually adjust higher, despite short-term bearishness in the stock. Okay. Number two, does the company have a sustainable competitive advantage? Or Warren Buffett calls it an economic moat that protects it from competition. Number three, is the company safe to invest in? In other words, does it have low or conservative debt? Some companies can grow massively. They make huge amounts of money, but they take on too much debt. So the moment interest rates rise, or there's a financial crisis and they can't service their debt, or banks decide to pull back their loans, the company can collapse. So we want companies that are cash rich with low debt, and that makes a good business. So let's take a look. First and foremost, is Facebook a good business in the first place? Let's jump into the financial statements. So the first thing I'm going to look at would be the income statement. And I'm going to look at it annually, year on year, to take a look at how has it been performing in the long run. So first of all, if you take a look at revenue, the company's revenue in the last 1, 2, 3, 4, 5 years, take a look. From 7 billion, 12 billion, 17 billion, 27 billion, and 40 billion. So it's increasing its top line consistently year on year for the last 5 years. In fact, for the last 10 years. Okay. Next, we look at net income, net profit, 1.5 billion, 2.9 billion, 3.6 billion, 10 billion, 15 billion. Right. So despite the slowdown in revenue growth and profit growth, guess what? It's still growing consistently year on year. Not many companies can do that. Okay. If you click on this icon, you can see the revenue growth there for the last 5 years. Okay, net income, again, growing consistently for the last 5 years. So revenue is growing, net income is growing. Next thing I like to look at is cash flow from operations. Is the company's cash flow from operations increasing consistently? And we are taking a look at this figure, which is the net cash flow provided by operations. So again, 4.2 billion, 5.4 billion, 8.5 billion, 16 billion, 24 billion. Again, cash flow increasing consistently every year for the last 10 years, in fact. There you go. Again, not many companies can do that. So we know that this company has consistent growth. That's number one. Next question. Does the company have a sustainable competitive advantage that will protect it from competition, that will allow it to continue to grow in the future? That's the question. So what gives a company a competitive advantage? Or again, an economic moat? Well, a few things. Number one is a strong brand. Does the company have a brand monopoly? So in other words, the moment you think of the product, you think of the product category, is it a top of mind recall? So if I mention social media, what's the first thing you think about? All right, think about it. Right? I'll say most people would say Facebook or Instagram. Less likely Twitter. Okay. But maybe Twitter. Snapchat, not that much. All right, so basically you've got Facebook, Instagram, and Twitter. And guess what? Facebook and Instagram is owned by the same company. It's owned by Facebook. All right. If I talk about instant messaging, another social media would be Telegram and WhatsApp. WhatsApp is owned by Facebook. So Facebook owns the majority of the dominant brands. Again, Facebook, Instagram, and WhatsApp. So it's got a strong brand. Number two, Does it have high barriers to entry? It does in terms of what we call the network effect. The company has got a network effect, which means the more people that use it, the more people want to continue using it. So it's what we call a network effect. Right? Third thing is what we call switching costs. Is there a high switching cost that will lock in customers for the long run? And the answer is yes, because think about it. You've spent the last 5, 10, 15 years building up your Facebook profile. You've got all these likes, you've got all these photos, you've got all these friends that are connected to you. All right, and despite the recent scandal in Facebook, let me ask you a question. Are you likely to delete your account with all your photos, all your friends, all your likes, and jump to a new social media platform in the next 10 years? I don't think so, right? In fact, what's the alternative? Where else do you go to? Snapchat? Those are for kids, in my opinion, right? Twitter? Well, not really, right? Instagram, again, they own Instagram. So I think they've got a lot of sticky value. Customers are going to stay, all right? Now, Facebook makes most of its money from advertising revenue. The question is, would advertisers pull their revenue away from Facebook into another medium? Now, you should ask their advertisers. And one of their biggest advertisers is me. Yeah? My company, we spend close to over $1 million advertising on Facebook for all our programs around the region. And we are continuing to increase it year on year. And there's no other alternative to Facebook. The only alternative is Google. So we advertise on Google as well as Facebook. So I would say that customers are not running away, they're still having their accounts, advertisers are still advertising. So there's a strong competitive advantage, it's a wide economic mode. And if you take a look at Morningstar, you can see that on Morningstar's rating, you can see that it also rates Facebook as having a wide economic mode. There you go, wide economic mode, which again confirms my thesis that it's got a wide mode. Okay, all right, great. So, consistent grower, sustainable competitive advantage. Next thing, is the company safe to invest in? Does it have conservative debt? So if you take a look at the balance sheet on Facebook, you notice something really interesting. And again, let's take a look at the latest quarterly report on the balance sheets, right? Now, the company has got $42 billion in cash. $42 billion in cash in the bank, okay, or in short-term investments, of course, right? And here's the best part. The company has no long-term debt and no short-term debt at all. If you compare this to any other company, very few companies have that, all right? So there's no short-term debt and there's no long-term debt in its liability column. So this company has got zero debt. $42 billion in cash. It's extremely safe. So now we know it's a good business. Next question, what is the true value of its shares based on its current earnings, based on its projected growth rate, and right now at its price, is it undervalued or is it still overvalued? Is it a good price to enter at? So what I'll do is I'm going to use my intrinsic value calculator to calculate the intrinsic value or the fair value of the shares. All right. So basically to calculate, the first thing is I put in the company's most recent cash flow from operations based on the last 4 quarters, and it's $27 billion. All right. So basically, how do I get this figure? So how I get this figure is I go to cash flow and I look at the last 4 quarters. And what I do is I add up the last 4 quarters of the company's cash flow from operations. So this plus this plus this plus this, I get $27,956 billion. Okay. The second thing I put in would be the company's short-term plus long-term debt, which is again zero. Company has got no debt. Next, I put in the company's total cash and short-term investments that I showed you earlier. It's $42 billion. Okay. Now the company has a total of 2,894 million shares outstanding, right? Which is 2.8 billion shares outstanding. Now, the tricky part in valuing a company's shares is what growth rate do I use, right? Because that's really, really subjective. Like, what is the growth rate for the next 10 years? Because this will ultimately determine the value of the shares, right? For example, if the company is growing at, for example, 30%, right, the shares will be worth $389. But if the company were to only grow at 10% growth, the shares will be worth $140. Does that make sense? So the growth of the company, plays a big part in determining the value of the shares today. So what growth rate do I use? So let's answer that question right now before we put it in. Okay, so to understand the company's growth rate, let's again take a look at the statement that the CFO made that freaked investors out. And this is exactly what the CFO said on the conference call. He said, our total revenue growth rate decelerated approximately 7% in quarter 2 compared to quarter 1. Our total revenue growth rate will continue to decelerate in the second half of 2018. And we expect our revenue growth rates to decline by high single digits. So I would say high single digits, maybe 9%. Is that a high single digit? Or, maybe 7%. Could I assume that? Right? From prior quarters sequentially in quarter 3 and quarter 4. So what the heck does that mean? So what they're saying is that our revenue growth rate is going to decline by 7 to 9% in the next 2 quarters. Okay? So let's put it into perspective. What is the current growth rate of Facebook's earnings? Right? So let's take a look. Now, Facebook's quarter 3 2017 results. So this was last year, 2017 quarter 3. The company made $159 per share in earnings versus the expected 128. So it beat expectations, and this represented a 47% growth in earnings as compared to the previous year, 2016. Okay? So remember that whenever a company announces its quarterly profits, they always compare it to the same quarter in the previous year. Does it make sense? Okay? So quarter 3 2017 is compared to quarter 3 2016. Quarter 4 2017 is compared to quarter 4 2016. So in those 2 quarters, Facebook increased its revenue by 47% versus 2016 and 47.2% in 2016 for quarter 3 and quarter 4. Now, in the most recent quarter, which is quarter 2 2018, Facebook grew 42% as compared to the previous quarter. Okay? So the question is, what does the CFO mean? When the CFO says that, our growth rate is going to decline by 7 to 9%, does he mean compared to the last quarter or the previous year's quarter? What the heck does he mean? He was not really clear with that. So I've got two scenarios, right? Now, scenario number 1, what he's saying is that he's taking quarter 2 as the base result, which means the most recent quarter, Facebook grew at 42%. Okay? So what he's saying is that in the next quarter, we expect a 7 to 9% drop, which means in the next quarter, he expects revenue to grow at 33%. And in quarter 4, we're going to decelerate by another 7 to 9%, which means that we expect a revenue growth in quarter 4 to be 24 to 28%. Right? So what this whole thing means is that after the deceleration in growth, Facebook should grow at 24 to 28% moving forward. That's the first explanation of what he's saying. The second explanation is that what he's saying is that revenue will decelerate by 7 to 9% in quarter 3 2018 versus quarter 3 2017, the previous year. Okay, so this will mean a growth rate of 38 to 40% in quarter 3 compared to 47% in quarter 3. And in quarter 4, revenue will decelerate by 7 to 9% versus quarter 4 2017 of 47%. which means that in quarter four's growth, we expect 38 to 40% growth in Facebook. Now, if you're a bit confused by what I just said, review the video again. Okay, but basically what I'm saying is this. What I'm saying is that the CFO was not clear about what he meant. Is he comparing fall in growth quarter to quarter or versus last year's quarter? Okay. Now, the worst case scenario is what he's saying is that growth will slow down from 47% to 24 to 28%. That's what he's saying. But the best case scenario is he's saying that we're going to slow down 7 to 9% versus last year, which means that we still have a growth of 38 to 40%. So which growth rate do we use? Do we use 24 to 20% or 38 to 40%? Because that makes a big difference in our valuation of the shares. And my answer to the question is we use both. And we look at a worst case scenario and a best case scenario. Shall we do that? Okay. And whenever we make an investment decision, we always take the worst case scenario and say, based on the worst case scenario, if the shares are still attractive, we will invest. We never take the best case scenario. That's always a bonus. Does that make sense? Okay, great. So again, remember 24 to 28%. Let's take the lower range. Let's take 24% as the worst case scenario. And let's take 38% as the best case scenario. Okay? Great. So with that, let's look at our intrinsic value calculator. Okay, so we're going to put in, first of all, the best case scenario, which is the company will grow at 38% for the next 3 years. And let's assume that for the next 6 years, it will drop by 50% to, let me see, what's 38 divided by 2? Well, my mental maths is not the best. 38 divided by 2, not that smart, okay? 19%. Great. So best case scenario, Facebook will grow at 38% in the next 3 years, and it will fall another 50% in the next 6 years. So this will make our intrinsic value in Facebook $327. Let me write it down here, $327. That is the fair value of Facebook based on that best case scenario. Now, let's look at the worst case scenario, which is Facebook will only grow at 24%. So based on a 24% growth, and based on the fact that it would halve, and again, I'm being very conservative here. I'm assuming that 3 years from now, the growth rate will drop by another 50%. Our intrinsic value would be, ta-da, $200. $200. Okay? So this is our range. Best case scenario, 327. Worst case scenario, $200. Okay, now, whenever I come up with an analysis, I always like to compare my analysis to other analysts and see what they're saying, right? And let's see their perspective. So if I take a look at, if I go to Reuters, for example, where do we go to Reuters? All right, good. So this is on Facebook, on Reuters, and based on analyst estimates, they estimate the growth rate of Facebook to be best case scenario 38%. Well, that's what I said. Worst case scenario 12%. Well, that's what I said in the next 6 years. So the mean growth rate is 21%. So that's what they're saying on Reuters. So not that far away from me. So I'm saying 24%, 12%. They are saying 21%. Okay, so not too far away. I'm pretty happy with my analysis. Quite in line with what other analysts are saying, right? Alright, so based on an intrinsic value of $327, best case scenario, worst case scenario $200, is the current price undervalued? Is it cheap or is it still expensive? And the answer is, if you take a look at the current share price, it's $174 after we had that plunge. Now we are here, guess what? We are undervalued. We are, let's take a look. If you take 174 divided by $200, we are 13% undervalued. Right? So right now the shares are selling at 13% below valuation based on their worst case growth scenario. based on their best case growth scenario, we are deeply undervalued. Okay, so that answers the second question. Is the company over or undervalued? The answer is currently the shares are undervalued. But does it mean that it's a good time to enter right now? Remember, in the short term, stock prices are driven not by logic, they are driven by emotions. Okay, so whenever the market is pessimistic, is bearish, even if the stock is cheap, guess what? Cheap can get cheaper, low can get lower. At the same time, when the market is bullish on a stock, when they're optimistic on something like Amazon, right? Guess what? Even if the shares are expensive, they're overvalued, expensive can become even more expensive, higher can become even higher. So to decide if it's a good time to enter, we have to look at the charts to determine the price action, to look at the emotions that are driving the stock on a day-to-day basis. So let's take a look at that right now. So now we've analyzed the fundamentals of the business, we need to consult the charts. Because remember that in the short term, stock prices are not driven by fundamentals or logic. They're driven by the emotions in the market, bullishness and bearishness. And so technical analysis is a study of the emotions that drive the price in the short term. And if you want to fine-tune your entry, it's really important to understand what the charts are telling you in terms of, again, the emotions that are driving the stock. So the first thing is, well, let me just remove these lines first. So you can see that Facebook was on a very nice uptrend. It made a high of 218.62. And when it announced earnings before the market opened, the moment the market opened, it gapped down from 218 to a low of about 173. And it's currently at 174.89. Right there. So again, the question is, hey, you know what? Is that a strong level of support? Is it likely to go lower, and how much lower could it go? All right, and is it a safe time to enter at this level? So let's break it down. Well, the first thing is to ask this question. Okay, why did the price gap down to 174? Did it happen by chance? Nothing happens by chance in life. Everything happens for a reason. So if you look closer, you notice that this level is pretty significant because it is a significant support and resistance level. Okay, if you were to zoom in and you take a look over here, boom, this is a significant level because this was a previous resistance, and resistance. All right, this was a resistance. It broke out and became support, 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 support. So this is a multiple support level, saying that there are many buyers waiting at that level to support the price. So it gapped down right to the support level. So this is a strong support. But again, it could always break the support. Okay? And if it breaks the support, where is it likely to go? Where's the next level of support for this stock based on historical demand and supply patterns, right? And the next level of support I can see would be somewhere here. That's the next level of support. Because you can see this was resistance, resistance, resistance. It broke out, and again, it found support over here, okay? So this 155.98 is the next level of support. So if it breaks 172, that's the next target, 155. And if it breaks 155, where can we go then? I would say the next level of support would probably be here, right? There was previous resistance, broke out, turned support. Next level is 144. I would say it's unlikely to go below 144. All right, so 172, next level 155, next level 144. Right? The other thing which is really interesting is to notice that this level right now where we are is a Fibonacci level. Okay? If you take this as the beginning of the impulsive wave A, to B, right? So it moves from A to B and to C. This is a Fibonacci level. So let's check it out. Let me use the Fibonacci tool over here. So click A to B. There we go. Okay, let me redraw that without those lines. Hold on, let me just redraw that. Wow. Okay. So A to B. Boom. So you can see that currently at this price, we are exactly at the 61.8% retracement level. So 61.8% is a significant support level as well. Now, if you look at its previous retracement from here, this is A to B, right? So A, B, C, right? It reached again 50% to 61.8%. So again, it was a very close Fibonacci level. This ABC, again, at a Fibonacci level. So this is a very strong support level. All right, so the question is, if this is a support level, can we enter right now? Well, based on the charts, no, because we want to see a bullish candlestick reversal pattern, or we want to see a bullish sign from the candlestick pattern. And right now, what you see over here is known as a bullish engulfing candle pattern, which is a bearish pattern, because this bearish candle engulfs the bullish candle. So before I enter, I would like to see that first of all, the price should break above the high of this candle. So the high of this candle is, let's take a look here. High is 180.183. So I'm going to put a level here. Somewhere there. Okay. There you go. So I want to see the price get above the high of 180 before considering entry. That's number one. Number two, I want to see a bullish candlestick pattern. So for example, it could be a bullish pin bar, it could be a bullish engulfing pattern, or a one white soldier pattern. So I definitely want to see a bullish reversal pattern, and support is being held before I take my initial entry. Now we have analyzed the fundamentals of the company. So based on fundamentals, it's a really good business. And based on fundamentals, it is undervalued. But based on technical analysis, it is not time to enter yet, because although it's at a strong support, we don't have a bullish candlestick reversal pattern. So the question people always ask me is, Adam, what's more important, the fundamentals or the technical analysis? Well, it all depends on whether you're an investor, a long-term investor, or short-term trader. Okay, so let me give you an example. See, long-term investing is when you believe in the company and you want to get married to the company, right? Through good times and bad. Through sickness and in health, you're going to hold on through the ups and downs because you know that in the long run, the company will do well. That is the investor's perspective. So investors tend to focus very much on the fundamentals of the company. And timing the entry is secondary, okay? But if you're a short-term trader, then you want to focus more on the technical analysis because you want to get in and out really, really fast. So you focus on, do I have a good risk-to-return ratio? And I love to give an example. Here's a metaphor. So long-term investment is kind of like you want to get married to the stock, right? You want a long-term commitment. Short-term trading is kind of like a one-night stand. So let me ask you a question. If you're dating a girl or dating a guy, which is more important? The fundamentals of the person or the technicals of the person? Okay, what do I mean? So fundamentals means the person has got a good character, has got a good heart, is well educated, it's got a good job, right? That's the fundamentals, right? So technicals would be the person looks sexy, looks attractive, is hot, it's horny. Okay, what's more important? It depends, right? If you want to look for someone for a long-term commitment, then fundamentals are more important. The character, the person's education, for example, that's important, right? And in the short term, if the person's a bit moody, it's fine. You're holding through the ups and downs. You're willing to hold for the long run. But if you're in it for a one-night stand, then fundamentals are not important. Imagine you want to go have a girl or guy and say, you know what, let's go to my room. Before we go to my room, I want to check your university degree. I like to check your qualifications. I like you to, are you a good person? You don't care, right? As long as the person's sexy, it's attractive, you go for it, right? So same thing in the markets. For long-term investment, fundamentals are more important. It must be a good business. Okay, you hold it through the ups and downs. If it drops, you can buy some more because you hold it through the downs, right? But as a short-term trader, you've got no loyalty to the company. You don't care about the fundamentals. It's all about the one-night stand. Get in fast, get out fast, make some quick money, and that's it. So for long-term investment, again, like I said, we focus on the fundamentals. So Facebook is a good business and it makes a good long-term investment if you want to invest in a company. But to help us to time our entry, again, we could use the charts to help us to make good decisions. And what you could do is what we call dollar cost averaging. So dollar cost averaging means that if you have 10,000 to invest, do not invest all of it at one time. Invest maybe a third, 3,000 at this price right now. If it breaks the support, goes to the next support at 155, buy another 3,000. If it breaks and goes to 130, buy again. So you average down the price. And you can do that if you're having a long-term perspective. And for investments, you do not have a stop loss. Okay, there's no protection because you believe in the company, you know that it won't die, you'll come back one day. Okay. But for short-term trading, you always have to put a stop loss. You must always use protection. It's kind of like, in a marriage, you don't use protection, right? Well, at least I don't. Okay. But if you go for a one-night stand, which I don't in real life, okay, but in the markets, I do one-night stands all the time. If you go for a one-night stand, you got to put protection, just in case, right? So you have a stop loss, so you define your risk as 1R. So you always risk 1R to make 2R or 3R. And if it hits your stop loss, you get out, wait for the next bullish pattern, enter again, stop loss again, and you keep doing that until you get a winning trade. So remember, in short-term trading, your win rate's kind of like 60% win, 40% loss. When you lose 1R or risk, you lose like $3. When you win $6. And in the long run, you make money as long as you're right about half the time. Okay, with a stop loss. So it's a different perspective. All right, so if you're an investor and you believe in the long-term fundamentals of the company, you want to have a long-term commitment, then what you can do is you can buy right now at 174.89 because you know that the intrinsic value is about $200 in the worst case scenario and you're buying it while it's undervalued. But bear in mind that, again, cheap can become cheaper. So if you buy right now, right, if it breaks below to 155, you can add more shares to average down your cost. We call that dollar cost averaging. And again, if it breaks further down to 144, you can again average down. So do not invest everything at one go. Split it up into 3 or 4 investments to average down your cost. And you know that in the long run, okay, in 2, 3, 4 years, you're definitely going to make money on this stock because it is a good business. It's got a wide economic moat. It's a consistent performer. All right, so that's for long-term investment perspective. Now, if you're a short-term trader and you're in it for a one-night stand, then you do not buy it now yet. You have to wait for some kind of bullish candlestick pattern. Again, you're waiting for like a bullish engulfing pattern or a bullish pin bar. All right, and you can watch these on my videos on a powerful candlestick pattern. So, for example, if you see if you see a bullish candlestick pattern, and you can say, okay, I'm going to buy at 180.18, right? Wait for it to break the high of this candle. So I'm going to buy at 180. And if you're a short-term trader, always use protection, right? Remember that. So you may want to put a stop loss at, for example, 171, just below the low of this candle. So put a stop loss at 171, for example. So if you buy at 180 with a stop loss at 171, what is your risk per share? Your 1R risk would be about $9. So you're risking $9. And if it reaches the high over here, you're making about $40. All right, so you're risking $9 to make $40. That's risking 1 to make about 4. 1:4. So that's a pretty good trade, right? So again, as a short-term trader, once you enter, be prepared to either win $40 or to lose $9. Now, if it hits your stop loss at $9, you got to get out. You have to honor your stop loss, cut loss, get out at $9. And if it breaks and it goes down, wait for the next support at say 155. And if it bounces off with another candlestick pattern, again, re-enter at 155, stop loss at 150, profit target higher. So you keep doing that, and you're risking 1 to make 3, 1 to make 2, 1 to make 4. And as long as you're right half the time, you're very profitable. And that's the concept behind trading, right? It's a numbers game. So I hope that with that, you understand how to tackle investments and trades like the ones in Facebook. This is Adam Khoo. If you've got questions, leave a comment below. I'd love to hear from you. And thank you for watching. If you like this video, click on the subscribe button to get my latest video updates every month or every week. If you want to check out my live training courses in Asia or check out my online investing and trading classes, do check out wealthacademyglobal.com for my live classes in Asia or piranhaprofits.com for my online professional stock and forex trading classes. This is Adam Khoo, and I'll see you guys soon. May the markets be with you.